Imagine waking up one day and finding out that all your money has disappeared, not stolen by a hacker, not lost in a market crash, but taken by someone you trusted, someone who was on magazine covers, someone celebrities endorsed, someone who promised to keep your money safe. This is exactly what happened to millions of people in November 2022, when a 32-year-old with messy hair and cargo shorts pulled off one of the biggest frauds in history. His name was Sam Bankman-Fried, and in just 3 years, he went from living in his parents' house to running a $32 billion company. Then, in just 3 days, he lost it all. This is the story of FTX, the biggest crypto scam in history. To understand how this happened, we need to go back to 2019. Sam Bankman-Fried, or SBF as everyone called him, wasn't your typical Wall Street guy. He graduated from MIT, worked at a trading firm called Jane Street, and he was really good at math. But he didn't care about fancy suits or expensive cars. He drove a Toyota Corolla, slept on a beanbag, and said he only needed $100,000 a year to be happy. He claimed he was going to give away all his wealth to charity. People love this. Here was a billionaire who actually seemed to care about making the world better. In 2019, SBF started a company called FTX, a cryptocurrency exchange where people could buy and sell Bitcoin, Ethereum, and thousands of other digital coins. Think of it like a stock market, but for crypto. And FTX exploded. Within 2 years, it was worth $32 billion. SBF himself was worth $26 billion, making him one of the richest people under 30 in the entire world. Celebrities couldn't get enough of him. Tom Brady became a spokesperson. Steph Curry did commercials. Gisele Bündchen joined as an environmental advisor. FTX bought the naming rights to the Miami Heat Stadium for $135 million. They even ran a Super Bowl commercial with Larry David. SBF was everywhere, on the cover of Forbes, Fortune, meeting with world leaders, testifying before Congress. He donated millions to politicians. He was called the John Pierpont Morgan of crypto, the guy who would save the industry. But behind the scenes, something very different was happening. While SBF was telling the world he lived a simple life, he moved FTX's headquarters to the Bahamas, to a luxury resort called Albany. He and his top executives lived in a $30 million penthouse. But it wasn't just SBF. He brought about 10 of his friends from MIT to run the company with him. Most of them had never worked in finance before. They all lived together in the Bahamas, playing video games, dating each other, and making billion-dollar decisions. They called their group the Alameda House. And here's where things get interesting. Before FTX, SBF had started another company called Alameda Research, a crypto trading firm. Legally, these two companies were supposed to be completely separate. FTX was the exchange where customers could store their crypto. Alameda was SBF's private trading company. But they weren't separate at all. See, when you deposited money into FTX, you trusted that it would stay there, safe in your account, until you decided to withdraw it or trade it. That's how exchanges are supposed to work. Your money is your money. But SBF had built a secret backdoor in FTX's code. This backdoor allowed Alameda Research to borrow billions of dollars from FTX customer accounts without anyone knowing. And what did Alameda do with that money? They gambled it. They made risky bets on crypto prices. They invested in hundreds of random startups. SBF bought a $40 million penthouse. Another executive bought a $22 million property. They donated $100 million to political campaigns. All of this was done with other people's money. For a while, this actually worked. When crypto prices were going up, Alameda made money on their bets, and they could secretly put the money back into FTX before anyone noticed. But then, in 2022, the crypto market crashed. Bitcoin dropped. Ethereum dropped. Everything dropped. Suddenly, Alameda's bets weren't working anymore. They were losing billions. And they couldn't pay back the money they borrowed from FTX customers. By November 2022, there was an $8 billion hole in FTX's accounts. That's $8 billion of customer money that simply didn't exist anymore. And SBF knew it. In private messages that later leaked, he called his own company's balance sheet hilariously bad. He told his lawyers that FTX and Alameda had always been connected, even though he'd publicly claimed they were separate. But he kept lying. On Twitter, in interviews, on TV, he kept saying everything was fine. FTX is strong. Your funds are safe. Then, on November 2nd, 2022, a leaked document revealed the truth. It showed that most of Alameda's assets weren't real money. They were FTT tokens, which was FTX's own made-up cryptocurrency. Imagine a bank saying, "Don't worry, we have billions in assets." But those assets are actually just IOUs that the bank printed themselves. That's essentially what FTX was doing. When people found out, panic spread instantly. Customers rushed to withdraw their money from FTX. In the crypto world, this is called a bank run. Everyone tries to get their money out at the same time. November 6th, $5 billion in withdrawal requests. November 7th, withdrawals stop completely. FTX freezes all accounts. November 8th, Binance, FTX's biggest competitor, offers to buy the company. But after looking at FTX's books for just one day, they back out. Things are too messy. November 11th, FTX officially files for bankruptcy. From the world's second-largest crypto exchange to bankrupt in 3 days. Over 1 million people had money trapped in FTX. Some people had their entire life savings there. $100,000, $500,000, even millions of dollars. Just gone. And where was SBF during all this? Still in the Bahamas, tweeting bizarre apologies. "I'm sorry, IF ***** ed up." He did interviews claiming he didn't knowingly commingle funds. He said he'd just been bad at accounting. But the evidence said otherwise. Investigators found that SBF had spent customer money on real estate in the Bahamas, political donations, venture capital investments, a personal loan of $1 billion to himself. His parents got a $16 million property in the Bahamas. This wasn't bad accounting. This was fraud. On December 12th, 2022, SBF was arrested in the Bahamas. He was extradited to the United States and charged with wire fraud, money laundering, and conspiracy. His trial began in October 2023, and it was brutal. His closest friends, the people he lived with, worked with, built FTX with, all testified against him. Caroline Ellison, his ex-girlfriend who ran Alameda, admitted that SBF had directed her to use FTX customer funds. She showed messages where he told her to commit fraud. Gary Wang, FTX's co-founder and SBF's college roommate, testified that SBF had instructed him to create the secret backdoor that let Alameda access customer money. Nishad Singh, another top executive, confirmed that SBF knew exactly what was happening and had lied to investors, customers, and regulators. Even SBF's own testimony backfired. He claimed he hadn't known what was happening at his own company, that he'd been too busy with other things to notice billions of dollars missing. The jury didn't buy it. On November 2nd, 2023, exactly 1 year after the scandal broke, Sam Bankman-Fried was found guilty on all 7 counts of fraud and conspiracy. On March 28, 2024, he was sentenced to 25 years in federal prison. The judge said SBF had lied repeatedly, shown no remorse, and destroyed the lives of thousands of people. He's now sitting in a prison cell, facing the consequences of his choices. So what can we learn from the FTX collapse? First, trust but verify. SBF had celebrity endorsements, fancy investors, and appeared on magazine covers. But none of that mattered when the truth came out. Just because someone looks successful doesn't mean they're honest. Second, if something seems too good to be true, it probably is. FTX was offering high interest rates on deposits and seemed to be growing impossibly fast. There was a reason for that. They were gambling with customer money. Third, regulation exists for a reason. Traditional banks have rules, audits, and government oversight specifically to prevent frauds like this. The crypto world prided itself on having no rules, and this is what happened. And finally, this is a reminder that fraud isn't just about numbers on a screen. Real people lost real money. Teachers, nurses, retirees, people who trusted FTX with their savings. Some lost everything. The FTX collapse destroyed $8 billion in customer funds. It wiped out a $32 billion company overnight. And it proved that in the world of finance, the biggest risk isn't the market crashing. It's trusting the wrong person with your money. Sam Bankman-Fried built an empire on lies, and it only took 3 days for the truth to bring it all crashing down.